Hey, this is Nash Evans with Evans Energy and oilcashflow.com. Today I'm here to walk you through our current project. It's called the Pistol Ridge Multi-Well Joint Venture. We're very excited about this well. We're actually so excited about it, we named our operating company after the field years ago. This is one of those assets that we've kept our eye on for an extended period of time because we knew eventually we'd have an opportunity to buy it and own the properties. Before we even acquired the field, we purchased the pipeline. This was a very strategic move because this gave us direct access to the main sales line. The reason we did that was to prevent another operator or a pipeline owner from regulating our prices that we have to pay to get the wells to sales or prohibiting us from selling to the end user. Outside of the pipeline acquisition that took place a couple years ago, beginning of this year, we bought 22 wells in Pistol Ridge Field. We acquired them in February of this year. We shut the wells in, and now we're looking to take them all back to sales. Today, in this project that we're going to go through, you're going to see 22 of these wells. Just to let you know, over the last week, we have brought 3 of these wells online. So this is a producing project with in production enhancement. So what you're going to notice, we're going to have the deal over here on my right side, or left as you're viewing it on the computer screen, but the very front cover says it all. No drilling risk, production enhancement project. So if you'll follow along with me, we'll put it up on the screen so you can go along with me as well. I'm going to walk you through the actual fundamentals of the deal and some of the details so you could do your own due diligence. This field was producing 300 MCF a day when we acquired it. The reason we shut the well in is because all of these wells went to one central gathering station. So what that means, all the individual wells had a pipeline that brought it to one central location, and the water was separated, the gas was separated, and then it was placed into the sales line. They are very inefficient because you're not able to tell what well is producing what on a day-to-day volume. What we did after we purchased it is we took inventory of all the 22 wells, and you'll see this on the budget. The reason we did that is because we are going to completely reconfigure the production facilities for this field. We're going to let each well produce on its own meters and its own separators and its own production tanks. Therefore, we can monitor the success of each one of these wells. Very similar to buying an older house with old plumbing. Every 20-30 years, plumbing needs to be resealed. It needs to make sure that it is properly maintained. Valves need to be replaced. It is no different with oil and gas wells. One of the great things is the risk has already been taken in finding it, and all the infrastructure has already been in place. So our biggest thing here is efficiency. That is really what this deal is. It should be called a production efficiency project. Today as we talk, 3 of these wells are already producing 250 MCF a day. We anticipate on getting another 2 to 3 wells into production over the course of the next week to 2 weeks. That should take us north of 300 to 400 MCF a day. By the time we test individually each one of these wells, reconfigure the production facilities, we anticipate that we're going to be close to 600 MCF a day. Today, as I'm taking this video, it is the 7th of November, and natural gas prices are $7 an MCF. Let's talk about the economics here. A unit on our deal is 3% working interest in each one of these 22 wells. That's right, you get 3% interest in every single well that we have in this field, 22 of them. For 3% working interest, the cost is $120,000. I've done a lot of videos on the tax benefits to oil and gas, so I'm not going to waste a bunch of your time going through that, but please feel free to go back to my prior videos and see them. It is a very substantial savings to an investor by utilizing the tax benefits. And just big enough savings, what you're going to see on this page is $120,000 has a cost basis of $78,000. That means if you write off this investment in full and you are in a 35+% tax bracket, you're going to save $42,000 plus money that you would be sending to the IRS that is instantly a savings in your pocket. What that means is you only have to recoup $78,000 in income to break even. So for that 1 unit position, it's $120,000 with a cost basis of $78,000. If the wells are producing 300 MCF a day at $7 natural gas, you're looking at an income of around $10,000 a year. Again, this is what it's doing today. Over the course of the next couple weeks, you're going to see an increase in production. So if we look more at the 600 MCF a day, this is when you're going to see a big jump in monthly and yearly production. So 300 MCF a day, you're $10,000 a year. At 600 MCF a day, you're right at $40,000 a year. If these wells are producing 600 MCF a day and your income is $40,000 a year and your cost basis is right around $80,000 a year, and your cost basis is around $80,000, this is how you get to that 40 and 50% rate of return per year. Phase 3 and Phase 4, what we're going to focus here is long-term recompletions of the wells. We will evaluate each one of these wells on their own merit as soon as we get the whole entire field producing efficiently. After they are all in production, we will read the logs, see the current production, what the other field production has been from uphole zones, and then we anticipate on recompleting at least 2 of these wells. Very common that these wells can come in 300 to 1,000 MCF a day. That's why on Phase 2 and Phase 3, you're going to see a jump from 600 MCF a day to 1,000 MCF a day and 2,000 MCF a day. If you add 2 or 3 successful recompletions of these 22 wells, you get the potential to get $80,000 a year in income to $100,000 a year in income. This project is meant for the long-term investor. If you are looking to purchase something and then sell it 6 months down the road for a premium, this is not for you. This is somebody that is looking for long-term cash flow. That's why we use the name oilcashflow.com, because as we continue to get these wells into production, reevaluate, recomplete, we're going to take this field from 300 MCF a day to 2,000 MCF a day, and we'd love for you to be a part of it. Let's go to page 6. Let's talk about the assets and what are here. You're going to see on page 6 the 22 individual wellbores, their name, their API number, which is very similar to a social security number for a wellbore, and the total depth of that well. For 51% working interest, it's $2,040,000. So that puts a total price tag, if you were to buy all 22 of these wells, for $4 million. That gives each one of these wells a cost to acquire of around $180,000. You can't drill a brand new well today for $180,000. You're going to be a couple $1,000,000 getting it. The replacement costs and costs to recreate are the greatest opportunities this project has to offer. You're just not going to be able to acquire 22 wells at the average cost of $180,000 per well. But what we did, we took it a step further. So not just giving you the wellbore name, the API number, and the depth, we wanted you to be able to see it, because we know a lot of people logistically are not going to make time to see these assets on their own. So if you will click on the well itself, it will take you to a link in Google Maps that you can actually view it on a map. Therefore, you can see what is there from satellite imagery. And the following page is laid out the exact same way. This is an overview, so you can see how close these wells are in proximity to each other. Plus, if you click on this map, you will be able to see the Google Earth imagery, and you can go well to well and see what is in between them both, how they are all laid out in the production line and in the sequence. But let's move to page 8. Like I was saying, We acquired this field very inefficiently producing 300 MCF a day. This is our purchase statement from our actual purchaser of the natural gas when it was producing 300 MCF a day. That's out of 22 wells. Today, we're 250 out of 3. Page 9, this is going to show you what we're currently in the process of doing. After reworking each one of these 22 wells, this is the production that we have seen production reports of, that we've seen production history of, that this is what the wells should be producing when properly plumbed and properly being operated. Then you'll see it phase 2, it goes to 590 MCF a day, 1,300 and 2,000. Outside of everything I've already gone through, there's a lot of issues in the oil and gas industry today. A lot of it deals with the same issues that you're dealing with in your business, and that is supply and demand. We are trying to eliminate the issue of dealing with third-party contractors as much as we can. So what you're going to see here that you get with us that you're not going to get with a lot of our other competitors is we have 2 workover rigs and a third one that we are looking to get in rotation here pretty soon, but we have our own workover rigs and our own crews. And when we start reworking these wells, we'll be able to go well by well by well and not having to wait for a third-party contractor. In addition to having our own workover rigs and crews, we have our own swab units and we have our own pump systems, flowbacks, and everything else. So after we get the well recompleted, we have our own units that can get the well into production and can monitor it and repair things as they need to be repaired. That gives us the capability to move lightning fast in an industry that is very delayed currently. Another plus to this is we have already purchased majority of the production tanks for this field. We acquired 10 oil and 10 tanks that will be used for oil storage tanks, separators, and water storage tanks as well. But we want to be very transparent on where your money's going. So the $2,040,000 for 51% working interest, the budget will show you a complete breakdown of what we estimate it's going to cost to get all 22 of these wells up and going to where they should. Page 13, in addition to having all of the production equipment, recompletion equipment, workover rigs, you're also paying for the team. We have our own engineers, our own crews, production superintendents, and landmen that are working for you to make sure that everything is done right. We want to make sure the legal is done properly, the right-of-ways are properly contracted. Justin Brent is our in-field engineer. He will be overseeing this from start to finish. And who you're going to see in the field and in the back office is our family. My mother, Pamela Evans, my father, LeVon Evans, me, and Brian Bunnell. Brian's been with our team, I believe it's 16 years this year. But you've got a lot of history in this field, history in the management involved in it, and the experts that it takes to make this a very successful field acquisition. We also give you a lot of additional resources too on this page. If you want to see a very specific scenario of how the tax benefits work, go to oilandgascalculator.com. This is a long-term cash flow project. I can't emphasize that enough. There's no reason these wells are not producing 20, 30 plus years from today. Right now is the greatest time to get these wells reworked, recompleted, and producing efficiently, because you can make your money back a lot faster in a $7, $8, $9 natural gas environment than you can in 2. Long term, when the natural gas prices do come down, and we anticipate that being a couple years, all the work's completed and all you're having to do is sit back and cash flow these wells and monitor them on a month-to-month basis. We hope you can join us in this project. We're very excited about it. We'd love to work with you. And if you have any questions, please give us a call at 214-427-8980. Again, I'm Nash Evans with Evans Energy 2 and oilcashflow.com. Thanks for watching.